Good morning from sunny and unseasonably warm Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, March 8th, 2026. In today's podcast, our focus is on the benchmark S&P 500, which has essentially been drifting sideways since late October. Sideways trends mean investors don't know what to do. Tactically, the minor trend in the S&P 500 turned down last week, with the index declining to its lowest level since November the 25th, but it has managed to hold primary tactical support at 67.20 after testing it twice last week. We'll take a look at that chart a little bit later in the presentation. Strategically, major trends are being tested in the NASDAQs, both the NASDAQs, the composite, and the NASDAQ 100, and also in market cap behemoth NVIDIA in the form of their 200-day moving averages. A breakdown through these key levels would be likely to accelerate last week's decline. From an inflation standpoint, the 5-year break-even inflation rate has been incrementally rising since late December. When this metric is rising, while economic growth is slowing as it is now, it historically tends to coincide with a weaker or declining stock market. Economically, when technology stocks are underperforming the broad market, bond prices are outperforming stock prices, the energy, utilities, and industrial sectors are outperforming the S&P 500, all which are happening now. And again, the 5-year break-even inflation rate is rising. It points to a late cycle inflation pressure environment with rising economic uncertainty. This is often described as late cycle inflationary slowdown or stagflation leaning. In just a minute or so, we're going to look at some charts, some important data series, and some of Asbury Research's own data-driven models pertaining to all of this. But before we do, let me just take a minute to tell you a little bit about us. Asbury Research is a registered investment advisor. We've been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year in business. More recently, we have created 4 model portfolios using our own proprietary models like the Correction Protection Model, or CPM, and the SEAF model, which is our sector rotation model, as building blocks for the purpose of providing trading signals for managed accounts. These model portfolios have all been developed through rigorous 8-year backtests and have been trading in real time for almost 2 years by both individual investors and professional money managers. These model portfolios are designed to produce S&P 500-like performance, but with significantly less risk, which means lower drawdowns, lower standard deviation, and lower beta, or to produce relative outperformance versus the broad market, but with similar or slightly lower risk than that of the S&P 500. If you like to manage your own investments and you're kind of a do-it-yourselfer, we have 2 different levels of research service available. Our Asbury Premium is what we launched the business on back in 2005. It's for more serious investors and includes the latest updates on all of our models. You can find out more about this service by clicking the research tab right here up top. And if you want further information than you can find here, including pricing, you could go to the contact tab, tell us what you want. We could either give it to you in an email, or we could set up a time where we could do a Zoom together and give you even a little bit more information. We also have an entry-level Substack newsletter for $25 a month. There it is. Does not include any of our trading models, but offers selected reports and a special model called the SORT report, which we're going to look at in just a minute. This is basically a kind of a beginner version of our research for somebody that may be following us, maybe subscribes to our YouTube channel, likes what we're doing, but isn't ready to take the plunge into the Asbury Premium service. Again, it's $25 a month. You get 3 reports a week that we're going to look at in just a minute. There's also a free version of this, asburyresearch.substack.com. If you like our stuff, if you watch our videos, it's kind of a no-brainer to just sign up for this. You're going to get a free report every week. And it's just, I think it's a good way to learn a little bit more about us and our approach to markets. If you prefer a managed account and are an individual investor, or if you're a portfolio manager that might be interested in reform model portfolios, you could click, going back to asburyresearch.com, click on managed accounts here and select the portfolio or portfolios that you're interested in. Our Asbury Aggressive, Asbury Balanced model portfolios are outperforming the S&P 500 in real time since January 2025, January of last year. All 4 model portfolios are outperforming the S&P 500 year to date. Of course, past performance does not guarantee future performance, but our model portfolios have been doing a good job amid some pretty difficult market conditions over this past year or so. All of my own equity-related investment money is invested in all of our Asbury Research models. Okay, now let's look at some charts. That's why you're here. So let's go inside the Research Center. This is the password-protected part of the website. And let's have a look at the Asbury 6. The Asbury 6 is our daily under-the-hood assessment of what the internal health of the market is. We look at this daily. It's updated daily, usually about 2 hours after the close inside the Research Center. And we backtested a lot of indicators in various sets of 3, sets of 4. What we were looking for was a small group of indicators that would give me a lot better understanding of what the internal health of the market is than by watching the S&P 500 every day go up 100 or down 100. It was getting to be very difficult to stay with a good idea because of the intraday volatility. So we built a model by finding 6 indicators that I've used throughout my 43-year career that work really well together as a team. So we've got the rate of change in the S&P 500. We've got the relative performance of stocks versus bonds, investor asset flows, volatility, trading volume, and market breadth. These are based on the close. So after the close every day, when all the data comes to us, we figure out how many of these 6 are either green, which would be bullish, or red, which would be bearish. Right now, through Friday, they're all red. These are the dates. So you can see between 3/5 and 3/6, which was Thursday and Friday of last week, that's when 5 of these flipped to red. So there was some tactical damage done at the end of last week. This is meant to be an indicator rather than a model. Again, daily indication of the broad market's internal strength. We look at it as kind of an EKG for the stock market. The A6, with an 8-year look back, it's underperformed the S&P by about 2% a year annualized. Again, this is going back to the latter part of 2017, but the maximum drawdown during that whole time was 11.5%. The S&P's maximum drawdown during that time was 34%. So this was meant to let people know when danger is coming, and it does a great job of that because the max drawdown is a third of what the S&P 500 is. So you hear me talk about drawdowns a lot, and this is why. When you're 30, you can make a lot of mistakes in the market. Your dollar cost averaging, I'd say for the first at least 15 years or so of your investment life. Once you get older, once you get close to retirement, the game changes. It's like football. You could take chances in the first half. By the time you get to the fourth quarter and you have a lead, the clock starts to matter. You want to make sure you don't give the lead up. That's why I'm an older investor. I'm in my 60s, and that's how I look at investing. And most of our clients, when you listen to what they're telling you, they say, man, I love investing in the S&P 500. I love to be buy and hold, but I'm scared to death that a 2-month bad period is going to happen, and I'm going to lose a third of the money that I worked for. So we look at this a lot. Here's why it's important. Let's look at this one right here that I'm circling with my mouse. During COVID, which is basically February through April of 2020, the S&P dropped 34% from top to bottom. That's what they call a maximum drawdown. So here, if it dropped 30%, you need to make 43% back the other way just to get even. And again, if you're older, it really makes a difference. Let's go back to the website and move forward, and we're going to look at some sector rotation. So we're going to go back to the research center and we're going to look at our SEAF model. SEAF stands for sector ETF asset flows, and there it is. Here's our current signals for the SEAF model. So the SEAF model is a completely data-driven sector rotation model created to quantitatively identify long and overweight opportunities in U.S. market sectors by simply following the money as it's moving around the 11 sector spider ETFs, which if you put them together, that's the S&P 500. We do this in multiple time frames. So this number one here, we're looking at energy. We're number one all the way across, 1, 1, and 1. What does that mean? That means through the end of last week, the fastest money moving in to any one of these sectors, it was energy on a trading standpoint, which is 1 week, on a tactical standpoint, which is a month, and also on a strategic standpoint, which is a quarter. You add them up, and that's a 3. That's the best score that you can get. On the other side, financials, they were last in trading, they were last in tactical, and they were second to last in strategic, which gives them a score of 32. That's one off of the worst score that you can get. So looking at this, what happened last week in multiple time frames, the money is most aggressively moving into energy, utilities, and industrials, and most aggressively moving out of communication services, healthcare, and financials. We always trade the top 3. When the top 3 change, and this is rebalanced at the end of every week, we move with it. Right now, let's have a look here. There we go. This is year to date for SEAF in green versus the S&P 500, which is in blue. We're outperforming by about 9%. This is through the end of last week. Why is that? That's because SEAF told us for most of the year to be in energy and to be in industrials. Those two have done really well. As long as the money stays there, we're going to be there with it. If the money starts to move, we're going to move with it too. So hypothetically back-tested performance for SEAF, let's go back to where we were just for a minute. And there's 4 lines here. AOR is an ETF that emulates a 60-40 portfolio. If you're an investor and you've ever used an advisor, you've probably talked to an advisor that asked you about a dozen questions, and based on your answers, they prescribed some variation of a 60-40 stock and bond portfolio. Might have a little bit of commodities in there and might have a little bit of international, but it's essentially a static cookie cutter approach to investing. That's what the purple line is. That's how 60-40 portfolio has done since the middle of 2018. The S&P 500 is in blue. You've heard me mention CPM, correction protection model. That's orange. It emulates the S&P 500, but with about 40% less risk. This is the SEAF model. This is our alpha generator. Look how much better the SEAF model has done since inception. So just to give you an idea of these different models and their purposes, the SEAF model is meant to take advantage when there's a breakaway sector or sectors. This year so far, it's been energy and industrials. We have a long way to go in the year, but that's basically how this works. So let's get back to the research center. And the Asbury 6, the SEAF model, our ETF trade ideas, which is another one we're not going to go into today. are all a part of Asbury Research's premium research service. If you want more information about that, ask us. Go to the contact tab here, and we can answer questions about pricing, features of the service, whatever you might need. The next thing we're going to do here, we're going to go back to the Research Center, and one of our reports that we do every week, it's Keys to This Week. And as the name suggests, Jack and I probably look at 100, 150 charts, and we pick out 10 that we think are the most germane to what the market's doing right now and the most potentially influential to what happens going forward. I wanted to show you just a few of those today. Our first chart, which I had mentioned I was going to show you at the beginning, this is the S&P 500 daily going back to July of last year. October 29th, the high there was 69.20. We had a target of 69.50 back in July, early August, based on the breakout to new highs that the S&P 500 made at that time. It targeted 69.50. We got to 69.20, and then we've got all this sideways chop. 7,000 is a big area because it's all-time highs and it's a big round number. When the market's at all-time highs and it doesn't have a physical resistance level to look at, it tends to gravitate to these big numbers. You're seeing that in the Dow right now. The Dow tried to get through Dow 50,000 for about a week, and that has since rolled over. Here's the support level that's really important this week, 67.20. It's the low that we made on December the 17th, right here. We retested it on March 2nd, which was Monday of last week, and then that's where we held on Friday. If we break through here, the next level is down about 65.83. That's where the 200-day moving average is. It's a major trend proxy. So through 67.20, especially if it's on a closing basis, should open the door for a deeper decline over the course of next week. This is the composite index, the NASDAQ composite index. I mentioned both of the NASDAQs were testing their 200-day moving average. Here it is, right here. Right on the 200-day moving average, hovering right above it. And just below that, we've got the low that we made from back in November. If this gets broken on a sustained basis and not for an hour, that is going to turn the tide. It's going to suggest that we're going through a major trend change in the market-leading technology area, and that could be big trouble for the market. The next one we're going to look at is cumulative volume. Cumulative volume turned up right around Thanksgiving of last year by rising above its 21-day moving average. Why the 21-day? That's Asbury Research's tactical time period. And we didn't set the world on fire here, but we generally held the uptrend. But now you see it's starting to break down. It's starting to drop. Volume indicates urgency to buy. When you see that volume start to recede, lack of urgency to buy, and that generally is going to take the market lower. We crashed through that on Friday. This is Friday, this little highlighted area. If that volume continues to drop next week, we're going to have further weakness. So that's another important thing to watch. This is the NASDAQ, and this is the total net assets, or the AUM, assets under management, invested in the QQQ, which tracks the NASDAQ 100. Look what's happened here since February. Drop below its 21-day moving average, and we've got this weakness in NDX. So another thing to watch. Volume is starting to drop off. Assets, the AUM, starting to come out of the Qs. If these continue into next week, we're going to have some problems. We're going to have a tough week coming up. Tough couple of weeks maybe coming up or more. And then finally, I had mentioned the 5-year break-even inflation rate. And this is right from the Fed's website, Federal Reserve Bank of St. Louis. And you can see since Christmas of last year, slowly rising. If you look at this in a long-term chart, it doesn't look like much, but on a daily basis, and we're really sensitive to small moves in the market because we're tactical investors, we're tactical traders. This is not a good sign for the market. If it keeps up, it indicates that the bond market, or it indicates that investors are pricing in more inflationary pressures, and this is typically not a good thing for the market. Finally, let's take a look at our Substack entry-level product, and let's jump back over there. Right now, there are two components to this. There's our Asbury Research chart focus, which is here. Looks a lot like the keys to this week that I just showed you. A lot of charts, a lot of information, a lot of detail. Also, our sort report. And this is the sort report. This is a quantitative sifting device, let's call it. We look at a lot of assets here. We look at commodities, crude oil, interest rates, US dollar, gold, technology, crypto, emerging markets, global equities minus the US, and small cap. And we measure them by 3 different metrics: trend, relative performance versus its benchmark, and also asset flows, the money flows that are moving in and out of this ETF. This tells us which parts of the global markets have positive trends, are outperforming their benchmarks again, and have positive asset flows, which those asset flows are which drive prices higher. It's a very low-cost way to make better investment decisions that are based on data and not someone's opinion or an economic forecast. It took me a long time to learn this, but forecasting is a euphemism for guessing. Forecasts will get you on TV with a nice suit, but to me, I want to read the data. I want to know what the data says. I want to know when the data changes. So this tells us right now the two that are clicking on all cylinders are both commodities. You've got the commodities here, all the way across is green, and you have oil. Oil prices are green all the way across. So if you were asking me, John, where's the opportunities right now heading into next week? It would be commodities. There's a lot of ETFs that track broad indexes of various commodities, and also just the oil market by itself. So there you go. Let's get back to our page, our landing page. It's asburyresearch.com. There we go. And that's Following the Money for this week. Our next Follow the Money podcast is tentatively scheduled for, the 8th? It'll be March 22nd, 2 Sundays from today. I hope to see you then. In the meantime, if you have any questions about what we do in terms of research or in terms of managed account services, you can contact us right here on the contact page at asburyresearch.com. We'll see you in 2 weeks. Stay warm. It looks like spring might be coming. And make sure you like and subscribe. We'll see you in a couple of weeks. Thanks for watching.